everyone. How's everyone doing today? And welcome again to our new episode, the newest episode of the series Trade FX for under $5,000. This series is about best Forex indicators. And first of all, how's everyone doing today? Hope everyone's good. Please give me a thumbs up if the voice check is good. So just to test the voice. I see a few attendees this morning. Alexander, thank you for the thumbs up. Thank you, guys. All right, so let's start because so we have a lot of material to go through today. I will try not to make it long, and half an hour. Please start beeping me as soon as the 30 minutes have gone by. So let's start. Today we're going to learn about simple moving averages. Okay. Moving averages. Let's use the term moving averages because, as we all know, or if you have done your research or if you have traded before, we have simple moving averages and exponential moving averages. It's two different math formulas, and so we will. I personally only use the simple moving averages. However, when I teach, I always tell the people that I coach or teach, please use your own indicators, whatever you're comfortable with. I share with you what I use because this has been, I have, maybe I got used to them. Maybe, I'm just too old to learn anything new. But by all means, if you think that you have found, an indicator that works, because the thing about technical analysis is that you have to adapt to it and not it to you. So whenever we're using technical analysis, we have to change and alterate the measurements a bit. So it doesn't mean that it's written in stone. So let's say I use a simple moving averages. Let's say I use a 50-period simple moving average SMA, and I'm switching. And I see that the 20 is working better on this particular instrument, on this particular time frame, then I will use the 20. I will not be stubborn and say, no, I always use the 50, I'm going to keep using the 50, okay? And the same thing applies for other indicators. For example, if you use a MACD or a exponential moving average that you have been reading about and you think that it's gonna work on the instruments that you trade, then you have to I will show you a few charts and tell you exactly what we're looking for. We're looking for the price to be adapted to these indicators and not vice versa. As I said, you can't impose the indicator on the instrument. If it doesn't work, it doesn't work. Next, we're going to look at support and resistance secrets. A lot of people I know, many, much more than the people that know how to use them, do not know how to use them. So a lot of traders use them the wrong way, the support and resistance levels, okay? The third thing we're going to look at is breakdowns, and finally, overbought and oversold indicators, also technical analysis, okay? So this is pretty much a technical analysis episode. And yes, and we will look at a few charts, as I said, and we will also discuss. So please feel free to ask questions whenever you want. I can see your chats here, so whenever you feel like it, okay? Let's jump to the next. All right, so simple moving averages. Why do they work? They work because many people use them, okay? So simply because many people use them. There's no magic formula. I've said this many times. There's no such thing as this indicator told me to buy, so I bought. I lost money, and I'm angry. I don't understand why I lost. It's because, it's not. If it was a science or if it was a precise indicator, everything was so perfect. Everybody would make so much money, and you wouldn't need that course anyway, right? You would all be very rich. So there is no magic formula. However, they work because many people use them. Many people are looking at the same stuff. So it's a self-fulfilling prophecy. When everybody's buying at the same support level, prices are going to go up. This is going to be provided. This is going to be a support. to the market. So the same thing applies for the resistance levels or any indicator. So whenever you see that this support level, wow, look at this price, it's going down to the support level and bouncing back up every time. Well, not every time, 2 times. We spoke about 2 points, right? 2 times or more. So 2 times, it could be a coincidence. I'm not saying this is it, you have to buy it there. It could be a coincidence, simple coincidence, but at least we're trading with a strategy in mind and with a plan. What's the plan? If it crosses that support level, full candlestick below it, I'm out no matter what. Discipline, military, I'm out, and if it doesn't, it rebounds, I will maximize the profit. So I will wait for a sell signal or a resistance level to get out, maximize the profits. All right, so we learned all that previously. So that and just to show you why the moving averages work. So first, moving averages are used to identify trend direction and to determine support and resistance levels. So they determine support resistance levels as well. Yes, we can draw the support and resistance levels. Very important, very interesting, and I'll show you how. However, sometimes moving averages, most of the times, moving averages provide support and resistance levels when the market is trending only. If the market is choppy all over the place, don't look at moving averages. They have no use at all, So look at the big picture. When I say the big picture, I mean zoom out. So look at the charts, a bigger time frame chart, to have to know the big picture, right? You don't want to be looking at a 15-minute chart and keeping a position for 1 week. Doesn't make any sense. So you look at a 4-hour chart or an hourly chart, and then you keep the position for 1 week. But also you zoom out, meaning you look at the daily chart and you see the big pictures. Okay, I see the 200 moving averages. It's been, the 200 simple moving average, and it's been providing a nice support level. So I will, moving out, all technical analysis is past data. So it doesn't predict the future. You have to think where there is the highest probability that this trend or this line continues to go. And if you see, let's say you see it going up, meaning, of course, if the moving average is going up, then the price is also going up. So there's a trend up. And then you will know that whenever the price pulls back to this moving average, very important moving average, because you've seen it before, past indicator, then you have to, imagine in your head, draw the line where you think, or where the highly likely that the moving averages or any other indicator goes, and then you have to predict. Okay, when asset prices cross over their moving averages, this will generate a trading signal for traders that use technical analysis. So the price crosses a moving average. So let's say this moving average is providing a resistance, right? And the price is going up to it. It touches it. Yes, it's supposed to be, a resistance level. So it's supposed to, maybe it will go through it a little bit, but then the sellers will come back in, and boom, the price will go back down. What does this mean? That this moving average is providing a resistance level. However, if a price crosses it after 1, 2, or 3 tests, it finally crosses it because the bulls or the buyers are much more aggressive than the sellers, or there is a catalyst, fundamental news. It's news-driven breakout, and it breaks that moving average. Then a lot of people that use technical analysis will get buy signals. Okay, there's a buy signal here. It just crossed the moving average, so automatically they will start buying. If you're short people, they will start covering. What will happen? The price will go up, will surge much higher. Okay, so whenever there's a cross, it usually surges. It doesn't just cross. If it crosses just a little bit and then is shy to go above it, and just a little bit above it, a couple of hours above it, and then you see that there's a big move downwards, it means that the resistance is still there, even though it crosses. A lot of people would come, a lot of my students would come and tell me, Ronnie, it crossed it. Look, it's obviously 1, 2, 3, 4 candles above it. Yes, it did, but it's not really surging, is it? So your line is not perfect. Never underestimate that or overestimate your own indicators. These are just formulas that people wrote in order to try to predict what's going to happen, right? So again, it's not sunk in stone. It's not a magic formula. So sometimes it will cross it a little bit, but you have to see a surge for you to know that really there's what does a surge in price mean? It means the buyers just, pushed it up and the sellers are losing the battle. Okay, so third, the time frame chosen for a moving average will also play a significant role in how effective it is. Okay, so as I said before, if you're using a 15-minute chart and telling me, oh, the moving average, look, it just crossed it. Well, you gotta use a larger time frame. You can't, unless you're a scalping day trader professional. That I've met a few of those kinds of traders, but extremely hard to make money scalping and day trading. So if you're a beginner, don't try it. And usually these guys use 5-minute, 15-minute time frames. Okay, they don't even look at larger time frames. Why? Because they're scalpers. Remember, so they'll be in a position for a few seconds, maybe a minute or two, but not more, right? So if you're looking at a 5-minute time frame, you're not supposed to be staying in a position for an hour, because you can only predict the next few periods, so the next few 5 minutes. Let's go to trend identification. So what did I mean by trend identification? Look at here how the moving average is providing a support for this instrument that is going up. Every time it rebounds to the moving average, buyers step in, boom, there is a surge in price. Again, another test, and boom, this time what did we do? What happened is higher high. Remember the higher high, higher lows, or lower high, lower lows. So higher high, very, very bullish signal. And then a retracement, retest, back to the moving average, slightly below it here, right? But boom, again, surge in price, higher high. So this is obviously an uptrend market. So what are you supposed to do whenever there is a rebound back? What you're supposed to do is never go against a trend like that, never. Unless you see a very clear reversal signal, extremely clear. I usually wait for 2 signals for me to go against a trend like that. Don't ever try to say to yourself, this is too high, the price is too high. It can't go any higher, okay? There's no such thing. So let's say you're trading gold and you say, gold is at 2,000. This is too high, man. It can't go any higher. How high is it gonna go? 3,000, 4,000? Well, yes, it could. So never go contrarian. I call these people contrarian traders. And don't get me wrong, you're going to maybe meet a lot of contrarian traders that make a lot of money. But in my opinion, it's not worth it. The contrarian traders have to be extremely patient. And how they do it is they make one good trade on maybe 50. One works out of 50, but they make money because they're so disciplined that they will ride the whole reversal back down, whereas the small losses they will cut. So if you don't have this kind of discipline, it's not going to work. So plus 50 bad trades to get just one. I think it's so frustrating. So that your stress level is going to go extremely high. You're going to probably, go crazy before you start making money. So just go with the flow. Easier. Just don't swim against the river. Go with it. Don't be a salmon. Okay. So EMA versus SMA, exponential moving average versus simple moving average. It's like I said, it's 2 different mathematical formulas. One is based on the closing price, the SMA. The other is based on the weighted average. So some analysts say that the EMA is faster than the SMA, meaning it will give you the signal a few time frames before the simple moving average. But as I said in my previous one of my previous episodes, I like things simple. So I use the simple moving average. I look at sometimes the EMA, or I imagine it in my head. I know that it's somewhere next to it, right? They're not very far apart. So they're extremely close to each other. And this is the blue line here. The light blue line is the EMA. And as you can see, it might be, on this case, rising quicker. And it begins here to fall quicker whenever the price crossed it. So here, what do we have here? we had an uptrend on top, and then it started, flattening. The curve started flattening a little bit, and then it crossed the SMA and the AMA. Well, it's not going to cross one and not the other because they're so close up. There's not too far apart, as I said. And then what happened is there is a drop in price. It didn't just cross it and is shy to drop below it. There's a big drop in price, right? And so what happens now is you have to start thinking, okay, this has been, if you're long, you're on the wrong side. If you want to take a short position, you have to start thinking that what used to be a support, the moving average, is now a resistance, and then you will go short whenever it goes back up to this resistance level. Okay, and so let's jump to the secrets of support and resistances. Let's look at a few charts before, just to understand moving averages and etc. I have a few charts open on TradingView. Randomly, we'll choose any one. If you have any instrument in mind, please also share that with us, so we will look at it and we will try to analyze. There's no such. You can't learn if you don't see things in your, by yourself with your own eyes. And so that's why I always tell also my students to trade as soon as they can, even with a small amount of money. So don't spend too much analyzing. Don't spend too much time, analyzing, and don't spend too much time on demo accounts, because you're not going to learn much from it. Whenever you start trading and you're in it yourself, that's when you start learning, and that's when you start understanding what you've been, reading about or teach or learning about or look or all the. Okay, I have a question from Francios. Hi, Rony. Sorry to interrupt. Do you think to use automated trading system is good to use since you're working full-time? Yes, it is. Remember, automated trading or artificial intelligence trading, AI, or whatever you want to call it. Some people also use on MT4, they use the expert advisor. These are people that actually programmed these robots or artificial intelligence codes, right? So if it works, it works, but you need someone to monitor these codes. You need to trust the person that gave you that code, right? So you need to not only trust them, you need to know that they're monitoring it the whole time, because the market changes and you have to adapt your programming accordingly. Just like trading, the market changes, you have to adapt your trading accordingly. So yes, you could. However, what I would suggest is, if you don't have a trustworthy person that's going to give you a code, or no record, performance record of years that it's been monitored and the strategy has been working, then what you do is, in case you're working full-time like I am now, you just trade. I do one trade a week, sometimes nothing, one position a week. For example, this week I have a long position in gold. Okay, I took this position actually last week, Thursday, but I'm still holding it now. So I have a plan in mind. I have a stop loss, so I'm I don't have to even look at keep looking at my phone or keep looking at the prices. I don't care, because I know exactly how much I'm going to lose, and if it goes my way, I know exactly how much I'm going to win, right? So my profits and stop losses are already in my mind, and so nothing to worry about, right? I'm not going against the trend. I'm following my own rules. If there is a sell signal or something, I have an alert in place that will, it will give me an alert, and I will just log into any computer from work or anywhere, and or on my phone, and we'll look at it more closely. So that's what I advise you at the beginning, Francios. Trade with a much longer term perspective, maybe one trade a week or 0 trades a week, maybe one trade every 2 weeks. Another question: what would you say is the best time frame for beginners? I will show you now. Okay, let's look at a few charts, and we'll look at them together. There's not one time frame that you should look at. You should just learn to don't look at them all, because you'll confuse yourself. I look at the hourly, because, as I said, most of my trading I keep 2, 3, 4 days. So I look at the 4-hour chart and the hourly chart, but I always look at the daily chart to get to know the big picture, to see the big picture. Sometimes even the weekly chart to know because the weekly chart will give you support resistance levels that are extremely important, that all of the bankers look at, all of the mutual fund or the fund managers look at. So these are important. However, the problem with the weekly is that they're zones. They're not actually lines, right? So it's a big zone. So let's say EURUSD, the zone would be at 120, 80. So there's an 80 pip zone that I have to, always keep in mind. If you're not willing to take that big loss, 80 pips or more, then you will know it, ahead of time. So let's look at, like I said, let's look at a few charts. First of all, we have to disable this screen. Oof. Sorry, I should have closed that window there, right? The light is getting... Okay. Oof, ouch, what am I doing? Okay, let's look at, for example, the EURUSD. Can you guys see the... Okay, wait a second. We're going to wait for it to load. What's going on? Okay, if you can see this chart, right, this is the good example of a trending up market be above the moving average. Well, the moving average is not very precise. It should have been much closer, right, because it's not really touching the bottom of the rebound, but it doesn't matter. We can always imagine it, or we can draw a new one, right? We can just add a new one. This one is a... What's happening? This one is a 50 moving average, I think. I can't seem to click on it. I'm not sure why. And anyways, and then it crossed it here. However, look at it. It's not a really big drop in price. So, and look how shy it was to really go a bit below it. So this really is a good example of when a cross happens, but it's a fake cross below. So it's still acting as support. However, if we were using a smaller moving average, meaning instead of the 50, maybe the 30 or the 20, it would have worked better. And then consolidation period, long consolidation period. We're talking about, this is a daily chart, by the way, so we're talking 3 months of nothing, right? And then the surge back. And here there was a resistance level. It crossed that resistance level. Can we all see that? How it crossed it, bounced back to my X resistance, now new support, and it tried again, 2 tests, 3 tests, and now there's something happening called a breakout. So you don't go short something like that. Can everybody see these charts, or am I talking to myself? I'll try to try to share just this chart in particular. So it's screen sharing, entire screen, no, application window, here you go. Okay, so the EURUSD, all right, we'll just Yes, the others are missing. I see that. I have to reload them, so I'm going to refresh here the charts and hope that they come back. Okay, just close the whole. Okay. Okay, we're good now? Sure. All right, so this is an example of a chart. I just put randomly trading view and it gave me the USD CAD. I probably must have been looking at it before. So this is the USD CAD. So this is the Canadian dollar, but the USD, the Canadian dollar is the denominator, meaning if the US dollar goes up, this pair goes up, right? So if the Canadian dollar is strong, this will show, there will be a drop in this pair, the USD Canadian dollar, all right? So we know now, for example, that the Canadian dollar was weak during this period and now is getting stronger during this period, right? So what happened here? Let's look at the moving averages. We're talking about moving average. Here, this is the 200 moving average. Is it? Yes, it is. So that's the 200 moving average, very important moving average. Maybe it's not important on this chart, on the hourly chart, because obviously it crossed it, it stayed above it. We know it is important because it's been, the price is very close to it. Why is it very close to it? Obviously, there's something there, kind of a support. However, if we look at the larger time frame, 4 hour, we see that the 200 moving average makes much more sense, right? Look at first of all, this moving average, whatever it is, again, it's the 50. So let's try the 60. Maybe it's a better moving average or even higher. We need something here. So you just adapt whatever you're using in order to get the good, you look at previous data. Okay, this is not bad, right? It crossed a little bit here, but it doesn't matter. This is a cross without a surge in price. Again, here, it provided a nice resistance. So obviously there's a trend down here. Okay, again, trend down here. And then it was making lower lows, right? Did it go back high to the high? No. It went back, it did a low here, lower low. Then it went rebound back up. Did it go to a higher high? No. Lower low, not a higher high, etc. So lower low. Finally here, it didn't go to a high. This was the previous high, so it's still downtrend. However, what happened here is it crossed that moving average. So if I was short anywhere here, this would be my signal to cover, right? So this was short. However, it went back to the 200 moving average, and now the 200 moving average is providing a very nice resistance level. So it is obviously not, can't or very difficult to cross it. And so this is a 4-hour chart. So after 4 hours, 8 hours, 12 hours, 16 hours, buyers realize that they're not going to push harder and they just gave up. People just take profits, get out of the position. Sellers come, also a wave of sellers comes back, and boom, there's a nice rebound in price from 32.44 almost to 31.80, now 79. So yes. And what I saw something also here, I'm not sure if you guys noticed. What did we see here? Price is surging. We learned last time a very important candle stick signal is what? The long tail up or the long tail down. There's a tail. Remember, the candle is a body with a top and a bottom, and there's a wick. And the wick shows you in that period what the high was, however, not the closing of that period. So the closing of that period is, let's zoom in here. The closing of that period is this. Let's say this is the candle. So this is the close of this particular period, the hourly period, but this is the high here. So it's a few pips above it. However, sellers just came back and boom, so that's why there is a wick. And obviously it shows in the next candle that really it gave us a confirmation that sellers are here. This is called an engulfing candle. The red candle is much bigger than the green or the blue, right? So the sellers are stronger than the buyers. It usually means a reversal, but I saw the reversal ahead. Where did I see the reversal? Right here. We spoke about this candle last time. It's good I saw this, because then this, it will teach you what to look for. And this is the long tail candle, long tail up. What it means is, we spoke about this last time, it means that price was surging, we were on an uptrend, everything was nice, people were buying, everybody was happy, the buyers of course were happy, but then something happened. There's obviously some kind of resistance level here at 32.50. So 132.50, there was a big resistance. Why? Because sellers came back, jumped back in, they're back in business, right? They're winning again. And what happened is, they showed us that they mean business. Now, I would have liked that this candle be red, but it doesn't matter. It's still a long tail up candle. It's a reversal signal. It's a reversal signal that needs a confirmation, right? I just don't wait for a signal like that and let's go short, let's sell here, right? We wait for a confirmation. What is the confirmation? Usually a nice red candle below it that shows that sellers are really serious and selling. Okay, so that's where I'll jump in the short. Or this confirmation came a few hours after, 1, 2, 3, 4, 5, 6, 7, 8 hours later. The buyers tried to make a new high and come back, but engulfing candle. So we have one reversal signal, confirmation that we're right, that the market is actually reversing, and look what happened. Okay, so this is nice. This is not about moving averages, but this was what we spoke about a couple of episodes ago. Not last episode, it was the psychology. The episode before that, we looked at some candles, and this was one of the reversal signals that we spoke about. Okay, there's 2 or 3. There are not many. You're gonna maybe read books of pages of reversal signals, but don't bother your mind with this. There's 2 or 3 very nice and that will show you nice reversal signals. So they have higher probability of succeeding. Yeah, well, yeah, Alexander, I like your question. Very, very, very important question. Yes, you shouldn't trade there because it's a revert. You're fighting the trend. No, you're not. Why aren't you fighting the trend? You are going against the trend. You're correct. However, this was very choppy. So this trend just started, a very, very choppy trend. Look at the chart. The USD Canadian, just like the USD JPY, or Japanese yen, have been very choppy, trading in a very rangy mode lately. We know that USD Canadian is affected by the price of oil. So oil prices have a big impact on the Canadian dollar, right? Because this is an energy, we call it an energy-related pair, currency pair, because the economy of Canada is the big producer of oil. So we know that. Look how it's now going down. This is live. So look how the reversal worked perfectly. What happens is you're safe, Alexander. Why? Because all you have to do is trade with your back against the wall, right? Resistance level 1, 2 points make resistance level. If you go short anywhere here, your stop is above that resistance level. So you have a very tight stop. Let's say you went short here, okay, at 32.30. Your stop is somewhere at 32.70. So you have a 40 pip, leeway. And so what did we talk about also last time? The 3-to-1 ratio. So 40 pips, I'm going to take at least 100 pips down. So from 32.30, we said we will cover at 31.30, or it makes sense here to cover at around 31.44 or 50, because this is where the moving average is. We have to assume that it's going to rebound off the moving average. So stick to a moving average. Why? Because it's more conservative this way. It's less aggressive. However, or you could just put a trailing stop, and if it bounces back, it will automatically get you out. If not, you will maximize the profits and maybe even make 100 or more pips on the trade. So you're trading with your back against the wall. Okay, Alexander, that's the purpose. Okay, let's look at another chart. We were trying to look at the EURUSD. So here it is. I'm sorry, we're wasting a lot of time on moving averages, but we'll go quick. So we'll look at one more. Okay, EURUSD. What happens here? This is the hourly chart again. We noticed that the moving average is, wow, look, the 200 moving average has been providing a nice resistance all the way, right? And then what happened is the cross, there's a cross, not in price. We're talking about a cross, small moving average or near time moving average is crossing the 200 moving average, which usually is a bearish signal, and the currency pair started going lower. Whether this is a resistance level that I drew ahead of time. So let's look at it. Look how the 200 moving average is providing a nice resistance, right? 1, 2, 3, 4, and then cross. And then on the way down, it didn't just cross it; it just stayed on it. 1, 2, 3, 4, 5 hours before it crossed it, and then again it rebounds back to it. So this is a very, very good example of how moving averages are extremely effective when you look at them the right way. Look at it. Look at this here. So obviously there is some kind of magnet that is attracting the price back to the 200 moving average on the hourly chart all the time. If you look at the 4-hour chart, it's much nicer. The price is above the moving average, so we're supposed to look for longs, like just like Alexander said. And then I drew here some kind of a trend line because I saw that it was also, you know, bouncing back up that trend line, and so most probably you can take this off because it doesn't really, you know. And then we'll talk about the resistance support levels. Where do you draw them? You draw them here because you have 2, so 1 and 2. So obviously we have 2 here, and we have another one here. It tried here. This is a false breakout, and this is another try, however failed breakout. So yes, you could go long here and fail, but you're trading with your back against the wall, so it's not a big deal. Part of the game, right? It's not. It doesn't. Otherwise, if it was perfect, everybody would make money, as I said. But we're disciplined, and we know that this is okay. We realize, oh, I'm not going to say the bad word. We realize that this is a failed breakout, and we get out. Again, here, failed breakout, and we got out. What does this mean usually? It means that people or buyers are not able to just break that resistance level. Sellers are getting back in, and boom, below it. Go back down, go back down. So usually after 2 tries, we don't try anymore. If it does a breakout again, don't go long, right? Because unless we draw another resistance level somewhere around here, and now this is our new resistance level, or this could be also a resistance zone. The level shouldn't be always a line. It could be a zone, the resistance and support level. That's what people don't understand. They rely so much on one number, and they will tell you, for example, even with us, we will send our daily market outlook, and we have to put a number. So we put 189.70, let's say. But don't really stick to 189.70. If you see it at 189.71, say, oh, this guy was wrong, because it's usually a zone. It's just that we can't write that it's a zone, right? Because there's not too much space when you read daily market outlooks with support resistance levels. Okay, so let's go back to our PowerPoint presentation and go a little bit faster. Okay, we're back here. So secrets of support and resistance levels. Like I said, we have to zoom out the charts, look at wider time frames. You want to see the big picture. Always you want to see the big picture. You want to draw the most obvious level. If the level sticks out, that level matters. If you're squinting your eyes, you know, asking, oh, is there a level or not? Then ignore it. If the level has to be obvious, you can't say, yeah, but you know, it can't be blurry. If it's blurry, forget about it. The first thing is that you want to see a power move into the support or the resistance. So let's say the resistance is here. You don't want to see the price come up, and then stop at the resistance and then, you know, hover around it, because it doesn't mean anything. You can't go short here. You want to see a power surge to a resistance with the sellers kind of came back in. So a power surge is buyers, and then buyers were stopped, you know, stop right there. Something happened for the buyers to, the momentum, the strong momentum to get weak, right? What happened is now there's a balance or equilibrium between buyers and sellers. So this is extremely important as well. You have to understand what you're looking for and try to interpret what is happening on the market, right? On that instrument that you're trading. What is happening in terms of people's behavior. Remember, technical analysis is all about people behavior. How many buyers are there? How many sellers are there? What are people going to do if this happens? And people's behavior is what you're reading or trying to read in those charts. So you have to use them wisely. For example, I've seen, this is a chart that I pulled off one of my students. And I asked him, what is this? Is this a shutter window? He says, no, these are support resistance levels. You can't draw something like that and expect to make money, right? What are these lines? There's support and resistance levels every single 20 or 25 pips. So they're not obvious. Obviously, there's a few of them that are obvious. I would understand why he put a resistance level here, but I don't understand what does that have to do with anything, or this. He's just drawing support resistance levels all over the place, and then this is not keeping it simple, guys. So most tech traders, again, don't know how to use the support and resistance levels, and they're the best technical indicators if they are used properly. The support resistance levels I use them a lot. 90% of the time I rely on them. 10 or 20%, let's say, I rely on the moving averages as well. So 2 or more, as we said before, 2 or more with strong move the other way. So look at that here. This is a moving average that this is a resistance level that we drew after 1, 2. Why did I draw them here? Why didn't I draw them there? Because the third one, it didn't even go above it. So I decided that, okay, I'm going to use this third high to draw the resistance level. However, I could have put it higher, and it doesn't matter because I can interpret from looking at this chart what happened. What happened is the nice surge up, prices was going up, and then something happened, and look at it didn't just stop it. It stopped it, and sellers came, and price dropped, right? And then the buyers came back, retest the same level, slightly higher, but that's a wick, so it doesn't really mean much. And then the sellers came back. But what happened this time? The sellers came back, and the price dropped lower than before. So they mean business, right? So this is a real resistance level. We don't have to see this part to understand that this is a real resistance level. And then the third test, the buyers couldn't even go to the resistance level. So they couldn't even, the momentum was not strong enough. And again, sellers came back in. And the last final try here, they barely touched the resistance level, but the sellers again came back in. And then finally here, we didn't even get close to the resistance level. This is pure, nice resistance secret or at work, because what happened here is we interpret without seeing all this that the buyers are just not strong enough. Their spirit is not there. Sellers are going to highly likely, we don't know, but there's a higher probability that sellers win this equilibrium consolidation mode, and that's what happened. Okay, so 2 or more with strong move the other way. So 1, strong move the other way. 2, strong move the other way. Resistance, we draw it. Okay. And like I said before, the level could be a zone instead of a line. This is the same chart, but instead of just drawing one resistance level like I did before, we draw a zone. So why? It's because if the buyers are able to go back up here in the zone, we know that if it crosses that and a full candlestick above the zone, meaning the buyers are, they got some help. There's a bigger wave coming in. Something happened, maybe an event, an interest rate hike cut, something happened, and the price is going higher now. Okay, so the zone is something that you will use with time. Don't use it now, because what happens with the zone is very, very tricky. Is you will put a resistance level, let's say here at 29, this is 23.95, and the next is very high, much higher. And so your stop will be much higher, obviously, and your loss will be much bigger. It will affect you psychologically, and it will hurt you, and you will be angry, and etc. So stick for now to a resistance and support lines, and just stick to the discipline to get out, even if you take a loss here and here. If it crosses it and you take a smaller loss, it won't affect your mindset. Okay, until later on with experience you start using the resistance level zones. Okay, this is a breakout. breakout breakdowns, what it means is, of course, we draw a resistance level, and then there is a breakout. Obvious. It has to be obvious breakout. And usually what I do is I wait for a confirmation. What happens is there is a breakout. I wait for the price to pull back. It doesn't happen often, so I miss on a lot of trades. What I do is, in order not to miss on a lot of trades, is like we said last time, I use the position building rule 3. So I would go in 1/3 of my position when it crosses, when I see that might be a breakout. I go in 1/3, and then I add to the position when I get this confirmation. What is the confirmation? Is when the price pulls back and touches the X resistance, now turn support, the line that I drew, and rebounds back up. So I know that this is now a new support level, and I'm confident that this trade is nice, it's going to make me money. I'm sure of it. I'm very confident. I go in another 2/3 of the position, and the third and last position I go in at another, also maybe when it starts making newer highs, so higher high, higher lows. Okay. And finally, overbought and oversold. Overbought, oversold indicators, there are many. You're never going to, you can look at our MT4 and see all the indicators that you have. You're going to be overwhelmed with all the indicators. You can have your own. Like I said before, I have no issues with anyone telling me this is something that works. You just have to adapt it to your own style, to your own profile, to your own personality. If it does work, then good for you. I use the RSI, Relative Strength Index. I believe that the RSI and stochastics have stood the test of time. I've tried to use many, but I saw that a lot of the overbought, oversold indicators, they work, but then all of a sudden they stop working. And oh no, and then you're confused. What do? I remove them. So the RSI and stochastics have worked for me more often than others, so I use them a lot. Recently, a few years back, I started only using the RSI on my charts because I keep it simple and I don't want to look at a few. Because sometimes the RSI will tell you one thing, the stochastic will tell you another indicator will tell you another thing, and then what do I do? So I always use the RSI. However, I use it as a secondary for confirmation. So if I'm using the moving average or support resistance levels, and the RSI is telling me the same thing, this is actually will boost my confidence and will give me extra confidence that this trade is good. Okay, and let's look at a few. Were you guys looking? Could you guys see that the position? I mean the PowerPoint, or because I just realized that I wasn't enabling this. Was I screen sharing this PowerPoint, Alexander? Anyway, I will re-enable the screen now, and we'll look at a few charts just to see a few resistance levels. Maybe one chart. We don't have much time. Sorry about that. But okay, so you can see the PowerPoint before. Okay, so I wasn't sure. I saw that it wasn't the screen wasn't there, and okay. Anyway, let's go to this application window, Chrome tab. Okay, now you can see this chart, right? Yes. Okay, so let's switch to another currency pair, GBP. Let's say the pound. The pound, remember, threatened. The EU has been threatened by the Prime Minister Johnson that if they don't reach a deal by October 15th, then they will just move on with Brexit anyway, right? So this is a very, very big or negative catalyst for the British pound. And so if we look at the 4-hour chart, we notice that ever since that news came out, the trend was going up. And then a catalyst happened here. And it was exactly here, actually, beginning of September. So, and this trend reversed. How do we see it? We see it here. You can see my chart, right? Yes. We see it here. This is the British pound chart. We see that there's an engulfing candle. So the price was going up, and then reversal signal. Very obvious engulfing candle. This is a much bigger candle than the bullish one here, right next to it. So I would have liked to see a surge in volume for confirmation. There was no surge in volume, but still it was a reversal. The catalyst, the negative news was so big that the pound just reversed, and we're talking about 34.60 as a high, and now we're below 30, so 29.60. So we're talking about 400 pip move, huge, event-driven move. We can draw a support resistance. Resistance for now here, right, at 34.73. Okay, and it doesn't really mean much here because we just have 1 point, but let's look at the bigger picture. So daily chart. So this is the daily chart. Does this mean anything? No, not much. There is a resistance here. Obviously, there's a lot of consolidation. Oh, yes, there is a resistance actually here. So we can draw it here. Why? I'll tell you why. Horizontal line, we'll draw it here because look, the same and then the same, right? So 1, confirmation 2, but there's a nice resistance here. It tried, and then finally fake breakout. It wasn't really fake. The pound was, the news was very good, and then nothing. And then the bad news came back, and then the price just couldn't keep going up. Plus there is a nice reversal signal here. Does anybody see it? Long tail up, guys. Long tail up. Very nice resistance reversal signal here. So now we know that this was supposed to provide a support, right? X resistance, new support. However, the news was so bad that it didn't. Can you see this, guys, here? This could be, but this is a daily chart, so this is not finished yet. This could finish red again. The day is not over yet. We need to wait for the day to finish to know how the candle will look like. However, let's assume that this is done and now the new candle is starting, this is a buy signal. Plus we have the moving average here, and on the long run, technically speaking, I wouldn't go short the pound here at these prices, okay? Because on the long run, we're still looking at the daily chart, and we still haven't. This is not a new low. This is the high. We're not below that, right? So it's very far. Plus we have a couple of moving averages. We have a cross in a moving average, small near-term moving average crossing a large-term. We have the RSI almost going into oversold territory. So yes, this is not a short at these prices. I would go long at these prices and go back. You can take easily. Let's say how much you can take. Hourly chart. Okay, obviously something did happen here, and buyers are coming back. I didn't read the news on the pound today, but we will look at it. And so yes, this is a nice. I would go long here, right? On the daily chart, it's an uptrend. On the hourly chart, it's starting to go back up. I know that I have a line here that I just drew now at 31. So it's now at 29.98. So 100 pips trade, not bad, right? The only thing is, I don't know where to put my stop because it will be very far away, and I wouldn't have a 3-to-1 success ratio. Let's look at the 4-hour chart. Yes, again, here there's a nice doji with a large wick, large down. So this looks like a reversal signal, guys. I wouldn't be surprised if this goes to 31 or more. So yes, and I can put my stop actually at the lower end of this, right? So around 29.40, 29, even lower, 29.30. Because if it does go here, it means that they're testing it, the lows again, and I don't want to bet that if they're going to break it or not. So just get out ahead of time. Okay. Any other charts you guys have in mind? So we look at the final chart before we end this session. Listen, guys, what we're going to do next is, I told you about one of my team traders. His name is Karim. He will be trading all these live. So whatever we talk about in all the episodes, he will be trading them live and showing you these trades live as well. So we will do a kind of a trading webinar. No talking, just trading. Maybe he will explain a bit what he's doing, but at the same time, we will be doing only 5 to 10 minutes of trading, because what happens is we're not going to get in and out in the same session. We're going to get in, analyze why we got in, put a stop loss and a take profit, and then we will look at it, monitor this position for a few days before we finally, or a few hours, whatever, how long it takes for it to reach our objective, and we'll get out of it. And so all these things that I'm talking about, I know are very overwhelming now. You're probably saying to yourself, there's too much, and I don't understand any of what he's saying. But once we start trading live, hopefully you will start understanding it better, and it will be working also for you. So let's look at just one more chart again. I don't know. Anybody? Anything in mind? Let's look at the Dow Jones. Dow Jones, the index, Dow Jones index that I trade a lot. I'm also been trading the Nasdaq a lot lately because the tech stocks have been moving a lot lately because of COVID-19. So this is the Dow Jones 4-hour chart. Nice, obvious trend up. The moving average here provided a support, even though it's not very, very obvious, not very clear. I can use another. This is this is probably long-term chart. So yes, so this moving average has been providing some kind of support, resistance, and then here even the 200 has been crossed. But the 200 hasn't. We look at multiple times it crossed it. So the 200 is not really reliable here. So don't ignore it most of the times because it's not very reliable. It goes below it a little bit. So just keep that in mind, right? And don't say, oh no, I'm gonna go short here, it just crossed it. Remember also the moving average the curve is up. So you don't go short when the moving average curve is up. And obviously, as Alexander said, you'll be fighting also the trend. However, the Dow was doing higher highs, and higher lows. And now it's a new low here. And so what if the trend is reversing and now it's high, lower high, lower high, lower high, along with lower lows? So the trend could be reversing. So we could, this is, in my opinion, more of a short with a stop if it does break this and makes a higher high than the previous high. So if we look at the daily chart, the big picture, we can draw resistance levels here, very obvious resistance levels here. Yes, right here. It's a zone here, remember, but it could be also a resistance level here. So this could be also a nice, stop in case you want to go short. However, I wouldn't go short now. I would wait. This is not an obvious short, so I would wait for it to, give me a better, nicer. Remember, there's nothing wrong with not trading. If you don't find the perfect setup, in my opinion, this is not a perfect setup, then you don't trade. Okay, USD JPY, Japanese yen. This is the big picture, the daily chart from first, I would say, very choppy, but with a tendency towards the downside. So the USD is getting stronger par rapport or relation to the JPY, but I look at a 1-hour chart for me to, you can draw resistance levels here, you can draw support levels right here, and trade accordingly. Yes, very nice support level here. Look, 1, 2, 3, and 4 with a fake breakdown here, but obviously very nice long here had we seen this before. So very nice long around 105.83. But this is a choppy market, again, not moving averages. You don't look at moving averages in this kind of market. This is the hourly chart and the bigger picture. Okay, so the hourly chart was telling us one thing, right? And now the 4-hour chart is telling us the opposite. It's telling us that this is more of a trend down kind of scenario with possible, again, not a perfect setup, untradeable. Okay, let's look at this for a while. Okay, this has been providing a nicer. It's also very choppy. However, it's a much nicer chart than the USD Japanese yen. Big picture, obviously a trend up with a consolidation here. However, this consolidation is nicer. Why? Because higher high, and higher high. So we also can draw a resistance, support level right here and go long. Okay, we can even put a zone. You could draw it, so it will be at around 1725. Okay, if you ask your question, if I'm willing to take the loss from 18, it's at 118 now, 118.10 even, 118.10 to 17.25, that's a big, this is daily chart again. So that's a big loss. So if you're not willing to take it and ride a nice move up, then this is a bad trade. But in my opinion, it's worth it. However, I would wait for it to go above the moving average. So on the hourly chart, we're still below that moving average, and we're hovering around it. It's been 1, 2, 3, and this is the 4th hour now. So not a very nice trade. We have to wait if it breaks it. If it doesn't, if it breaks it and the RSI is telling us oversold, perfect. Then we have 2 indicators, nice confidence, and we will accordingly. If you guys go ahead and find another chart, if you find it, just we'll look at it next time. In the meantime, it's been sorry about that again. Yes, I'll answer a few questions, and then that's it for today. Please, next time, as an assignment, if you want, look at a nice chart and try to find a setup. Whether you use resistance, support levels, or moving averages, up to you. Try to find us a nice setup to look at, and we'll all look at and analyze it next time. Cryptocurrency is good for long-term hold. I don't trade a lot of cryptocurrencies. I traded Bitcoin for a while. However, I use technical analysis only. So I don't read any news because I don't understand. If you want to trade something, try to trade something you understand. If you understand cryptocurrencies, Gopi, then, if you understand what the news is about, if you understand, because if you don't understand the news, how can you interpret the behavior of the buyers or sellers, right? So you have to understand what's going on and how this event is going to affect people's psychology, people's mindset. How is it going to affect their that people take action based on something. They just don't buy and sell randomly. And so why will people buy if there is a nice event or news? And why would people sell if there is a negative event or news? If you don't understand the news or cannot interpret it, there's no way for you to make money out of it. So I do trade Bitcoin. However, I traded it on a long-term chart using a very nice resistance that I detected, which was 10,500 back in the days. And I saw that everybody was talking about the 10,000 psychological level, but I saw that 10,500 was the actual resistance level. So I only bought when it crossed it, and I kept it until 12,000, and I got out. And so it was just a one trade thing, because I've been looking at this resistance level for quite some time, a year actually, and finally it crossed it, and I couldn't not take that position, and I took it. Okay, guys, so if you don't have any more questions, we'll leave everything for next time. Next time we will talk about, let's analyze a chart again next time, and then try to do other stuff that we will, that interesting stuff. Okay, bye guys, and see you next Wednesday. Thank you for attending.